is our economic survey output event, and the outputs are from our members and businesses across the Thames Valley. And it's probably worth just stating, for the purpose of context, that the region, because we've got a big old region, you know, starts in Swindon out west through West Berkshire, Reading, Wokingham, Bracknell, Slough, slews around up through Buckinghamshire and Oxfordshire. So you can tell geographically the size of our area. And this survey is one of the biggest and well-established business sentiment surveys, and has been going since 1989. But this particular event and this particular survey marks the first anniversary of our sponsorship with BDO, who have supported the survey. We're absolutely delighted to announce that BDO will further their commitment with the Chamber for a further 2 years. So thanks, guys, from BDO, because I know you were all on the call this morning. We really appreciate it. Because remember, we are a not-for-profit organisation, so your help in providing that information is absolutely fantastic. So thank you. The latest survey, just for me to summarise, really is represents a pretty solid quarter. End of Plan B restrictions in the UK, but there's been sort of reduced consumer sentiment around Omicron. We've got 28% of you reported increase in your trends for overseas sales, but a 56% said that business sales in the UK was actually going up as well. So that's good, positive news. But of course, we're faced with inflation, and that is what you guys have been citing as your number one concern across our region. But you don't really want to hear from me. Let's talk to the panel that we've got today. We got from the British Chamber of Commerce, David Barrier, who is head of British Chamber Research and all matters quarterly economic survey. He's the man to talk to. So he'll bring us figures from across the country with the numbers out today. From BDO, I'm pleased to introduce you to Christine Francis. Christine is a local director of 20 years, insolvency and restructuring. Christine offers advice to stakeholders and professionals across our region. Additionally, from BDO, we've got Rosalind Payne. Ros is a partner at BDO. She is an M&A specialist, helping business to develop efficient and compliant and aligned tax strategies. And clients include tech and life sciences. And finally, but by no means least, Janet Moore from Brewin Dolphin. She's head of market analysis at Brewin Dolphin, and is also on the Brewin Dolphin Asset Allocation Committee. She may be known to some of you. She's the face of Brewin Dolphin and appears a lot on TV through BBC, Sky and Bloomberg, etc. Last year, she was voted Best Industry Commentator. And if there wasn't enough this year, she's recently been named as the voice of LinkedIn for 2022. So welcome to all of you. It's very nice to see you. But without further ado, I'm going to hand over to David Barrier at the British Chamber of Commerce. David, over to your good self.
Brilliant, thanks, Tim. Hello, everyone. Pleasure to be here again. What I'll do, as usual, is just run through some of the key headline findings from our quarterly economic survey, as well as perhaps a look at some of the wider issues that businesses are facing going into 2022. So as Tim said, really, we've seen a relatively solid quarter in terms of some of the domestic sales indicators for Q1 2022, but there are some issues that I'll just touch on shortly. Just for context, our research program, which by the way is entirely dependent on your input. So first of all, thank you for anyone who's completed a BCC or Chamber Network survey. It's absolutely essential. But our research is widely used by the UK government, the Bank of England, the media, and of course other businesses, primarily to help with decision making. So in the case of the government, we're actually providing a lot of data that they don't have around how businesses are impacted by policy and how they're changing their behaviour as a result of external developments. So in many cases, we're actually the only source of credible data on how businesses are responding to a range of phenomena. So again, thank you for your input, because it's really essential to help create that evidence base for the UK government to make better business policy. But that's a bit about the research. In terms of this quarter's quarterly economic survey, as I say, relatively strong quarter based on some of the indicators that we collect. But I think the broader headline finding from the data that we've seen is that effectively one crisis, COVID-19, is giving way to another now, which is inflation. And this obviously poses a significant threat to the growth of many businesses in the UK. What we've seen in the survey, I've picked out sort of 3 points here. Firstly, that the recovery process has been unfolding, it's been underway over the last year, and that's a positive development, of course, as we come out of Plan B restrictions and the sort of wider COVID pandemic. Confidence has begun to return. More businesses are reporting increased sales. That's great. But there are some challenging issues around the lack of recovery to other indicators that we track, for example, around cash reserves, exports, and really important investment. And we'll touch on that in a second. But the second major theme running through all of this is inflation now. So this is now by far and away the top concern for most businesses. Of course, not all businesses. When I talk about these indicators, we're talking about what the general trend is. So some businesses will be immune from some of the issues that I'm mentioning here. But inflation is now the top concern for most businesses that we speak to. So we're seeing unprecedented cost pressures from a range of areas. And then thirdly, the third point I just wanted to make was around some of the international trade measures that we capture. And again, this is quite a challenging picture because we've seen obviously a global supply chain crisis in the last 12 months, but also the adaptation to the trade and cooperation agreement with Europe has posed a raft of challenges. Again, we'll just touch on that shortly. So those are the 3 points I was just going to quickly run through. On the recovery process, just to highlight the point here, by our measure, we ask businesses if their domestic sales have changed in the quarter. By this measure, actually, we are seeing quite a strong amount of businesses continuing to report improvements to their domestic sales. There's a lot of data to digest here, so don't worry about trying to examine everything. But what it's basically telling us is that since the massive drop that we saw in Q2 2020, which was the first quarter of the COVID lockdown, we saw a collapse, well, we saw a massive surge, I should say, in the percentage of businesses reporting decreased sales to the point where it's never happened before in the survey before. So you can see on the graph on the right-hand side, these two lines basically track the manufacturing sector and the service sector data in the quarterly economic survey. And what you see is a significant drop in the index figure in Q2 2022. Now, for the domestic sales indicator, that's actually recovered fairly sharply, and it's now above pre-pandemic levels, which is again on paper quite good. The challenge is when we look at other indicators for, say, structural economic conditions, so for example cash flow, investment, these data points haven't recovered. So while about 50% of firms have reported increased sales over the last few quarters, which is above pre-pandemic levels, that drops down quite a lot to just over a quarter, so 28% of firms reporting improved cash positions, which is again quite worrying, as it would indicate that while recovery is taking place, this isn't feeding through to improved cash positions, and therefore isn't feeding through also to improved investment intentions, which also is not looking good from the data. Another point to raise is around the recruitment indicators that we carry. So we ask businesses if they've attempted to recruit and whether they're facing recruitment difficulties. On attempted recruitment, this is recovering really nicely, at least on paper. So about 60% of firms now are attempting to expand their workforce, which again is a good indicator of confidence. But when we ask of those firms attempting to recruit, are you facing difficulties? 78% say yes, they are. And that's virtually at record highs now. So while there's clearly a large appetite to go out and recruit, a lot of firms are encountering difficulties getting the right staff. And we can touch on that in a bit. So on to international trade. It's a point I just wanted to make because I think it's probably being overlooked. The extent of the problem is being overlooked by UK government, I think. And what we're seeing is a very poor recovery process taking place here. So what we see in our own data is that effectively only about 20 to 25% of firms are reporting improved export sales. And that's way below where we need it to be to show any sort of recovery taking place in a meaningful way. And it's also below pre-pandemic levels. The graph on the right is actually the UK's export the amount of trade that the UK does globally. And actually, you can see here, again, to emphasize the point, that took a very sharp hit leading up to lockdown as the global supply chain started to unwind. And then it hasn't recovered to pre-pandemic levels. And in fact, the TCA, which is another problem that we're seeing, has perhaps compounded quite a lot of issues around trade with Europe. So when we ask businesses whether they feel that the trade and cooperation agreement is enabling them to grow and increase their sales, actually 71% of exporters disagree with that statement, which is very worrying, and only 12% agree that it is supporting their business. So this is the agreement that came into place after the UK left the European Union at the start of 2021. So lots of challenges here. And when we ask businesses, okay, what are the problems that you're facing? There's a lot, but we sort of found that it fits into about 5 categories, really. VAT requirements that businesses are struggling with. So, for example, some businesses need fiscal representatives in the country that they're operating in. Customs delays is a major issue. New rules of origin requirements, lack of access to labour. This is reporting that employees are moving back to mainland Europe. And perhaps a wider issue around the loss of equivalent around financial services, for example, healthcare, and potential new requirements like the UK CA mark, which effectively replaces the CE mark. So there's a whole raft of issues that businesses are talking about here, which have yet to be resolved in a meaningful way. Finally, the issue around inflation, I think, is the top issue that we're facing now by far and away. The graph on the left asks businesses if they're expecting price rises in the next 3 months, and you can just see how far those lines are going off the chart. You don't need to really see, it's very visual, you don't need to see the data really in any granular way to understand what's going on here. What we're seeing is that the vast majority of firms are expecting price rises. The vast majority of firms are citing inflation as a top concern now. And for manufacturers, the problem's even more exacerbated by shipping container costs going up 700%, raw material costs going up. Now we're seeing wage inflation as well, businesses reporting remuneration costs going up. So this is a major issue now, which potentially impacts growth, particularly for smaller firms. And when we ask businesses, how are you dealing with cost increases? Well, the top answer is that they themselves are increasing their own prices. So it creates an inflationary spiral. But if you look towards the chart here, so this is a list of things that businesses say that they will do in the face of increased costs. There's a segment at the bottom, I think I just wanted to flag this, which is quite worrying, where you've got 18% of firms saying that they would look to scale down their business or investment plans, and 5% saying that they would actually consider ceasing trading as a result of inflationary pressures. Now, the challenge is that micro firms, so those with fewer than 10 employees, are more likely to cite those last two options than larger firms, which indicates that they're in less of a strong position to deal with increased costs. So a lot more needs to be done to support those firms through these inflationary headwinds. So just to summarise really, and then I'll hand back to Tim. The positives, I guess, is that there's a recovery. The recovery process is taking shape as we come out of Omicron and Plan B. There's a release of pent-up consumer demand. There's obviously a recovering labour market. Unemployment rate is actually lower than pre-COVID levels, and there's of course a high savings rate as consumers and businesses sort of stockpiled cash over the last couple of years, and there's sort of pent-up demand that could be released there. The challenge is on the headwinds side. We've got supply and staff shortages, which businesses are talking about. Job vacancies are record highs, but we've seen disrupted supply chains, particularly obviously due to Brexit, but also now due to the Ukraine crisis. We're seeing a tightening of fiscal and monetary policy, so an end of the government support packages that were announced throughout COVID, and then a raft of cost increases from taxes, so national insurance contributions going up, national living wage going up, higher interest rates. So there's a whole package of cost increases on the taxation side. And then of course we've got that inflationary shock where there's higher energy bills, rising raw material costs, which are really hitting particularly manufacturers and retailers, but they're also starting to filter through now to professional service sector firms. So there's a lot of issues to unpack, but with that, I'll just hand back to Tim.
Thank you for that, David. One thing, an observation, and David, you might want to come back on it to me. When I was running the surveys as one-to-one, and I thank all those people who let me have those conversations with them, what I saw a lot of was the fact in the last 2 years, businesses didn't put up their costs or prices, I should say, simply because obviously they were conscious of the current environment we are with, everyone in lockdown and what have you. And I think what has happened is that in this, towards the end of last year and the beginning of this, businesses have suddenly said, right, we just can't keep up with the price of cost, so we're going to do it all at once. Instead of trickling the price up by a modest sum, we've seen great big lumps, and I wonder how much that is hitting the national figure.
No, that's exactly what we've been seeing nationally, Tim, as well. So when we asked businesses last year by what percentage they expected their prices to go up, the average business said about 7% in July last year. In January, when we asked the same thing, that figure had gone up to 10%. So the average business expected a 10% increase. So I think there has been, the only response really has been to further increase prices. But of course, there's a segment of businesses looking to grow out of this. There are a segment of businesses looking to scale down to mitigate against raw material supply chain shocks. So there's a range of responses, but I think the primary response so far is an inflationary spiral.
And I also wonder, as some of the more SME businesses use up their grants and things like that, I wonder if we'll see that bottom end number increase as well.
Yeah, there's a lot. I think there's a lot of milestones to keep an eye on, especially with the government support and the loans being called in.
Yep, thank you, Dave. I think we'll come back to you. If I can now introduce Christine Francis from BDO to talk about and commentate on the Thames Valley perspective and what we're seeing across our region. Christine, over to your good self.
Thank you. Thanks for that intro, Tim, and thank you for the invite to speak at this event. I think when I was first looking at sort of talking about what the Q1 results were showing in the Thames Valley region, and also my experiences from speaking to local businesses over the first 3 months of 2022, I looked back at where we were in December 2021 and thought we were in a very different place now to where we were then, and also probably in a very different place to where a lot of people were predicting we would be. At the end of last year, I think there was cautious optimism because businesses continue to see growth. However, the challenges that had been sort of consistent through 2022 2021 were still being faced, raising the question of whether these would become a greater threat in 2022. If anybody's seen sort of the survey report that's been issued for this first quarter, I think I make the statement in the summary that the first quarter has been an eventful one, and that's probably a bit of an understatement. As we've kind of highlighted, whilst the new year started with uncertainty over the impact of the Omicron variant, I think as we progressed through January and February and the government put in place its plans for lifting the remaining restrictions, some of us could be forgiven for believing that this would mark that period of long uncertainty due to the pandemic, which would then allow businesses to sort of better prepare for the future. However, I think the 24th of February will now not necessarily be marked for the day that the restrictions ended, but the day that Russia invaded Ukraine. And this obviously sent shockwaves throughout the world and created a new volatile period within the economy. Businesses that were already looking forward to a difficult phase dealing with the challenges identified from the previous year now had uncertainty thrown into the mix, and I would say significant uncertainty in trying to determine what the impact of the position in Ukraine would be. There's obviously been well documented concerns sort of in the media in terms of the issues that have been identified, and these continue, including the threat of ever greater increases in wholesale energy prices, the disruption and the ongoing disruption to supply chains, but then also the sanctions and reputational issues associated with working with Russian entities. I think looking at the QES results for the region, despite the impact of Russia's invasion, the responses indicate that businesses within the Thames Valley are continuing to produce relatively strong businesses. As has been alluded to already, over half of the businesses surveyed stated that they noted an increase in UK sales and UK orders in the first quarter. Likewise, overseas sales and orders have also increased from the previous quarter. Workforces are continuing to expand. 45% of those surveyed increased the number of people engaged in their business, and half stated that they expected this position to continue into the next quarter. However, to pick up on one of the key statistics that kind of stood out for me in the results, and to be fair, has been a general point of discussion across all businesses I've been speaking to in the last 3 months. The survey reflects that the difficulties with recruitment have increased and are now a key challenge for businesses in the region. This was obviously a consistent growing concern throughout 2021, and 73% of businesses in the region now say that they experience difficulties in that recruitment process. I'm not particularly seeing it as sector specific. It's wide ranging across all industries, and this includes professional services, healthcare and technology, all of which are significant in the Thames Valley region. I think businesses in general have managed to adopt a hybrid working environment where possible, following on from the pandemic, which has allowed sort of the individuals they employ to take advantage of a better work-life balance. However, one thing that I've picked up on from some of the companies I've been speaking to, and to be fair, it's probably more local technology companies, is even this still hasn't been enough to help them retain their staff. They now find themselves competing with international firms who are offering full-time work from home roles in order to attract candidates. I think what will be of importance going forward for businesses in the region is their ability to adopt new solutions, not just to attract new staff, and this is whether it's to replace lost talent or fill gaps created by growth, but also to improve the retention of their existing workforce. Just a couple of examples of some of the things that businesses I speak to have been doing or are considering doing. They're obviously continually assessing salaries and other benefits now, and primarily in their other benefits, pension contributions are always a distinctive that come out. And this is to ensure that they are competitive within the market that they operate in. And I think the companies I speak to have noticed that this is no longer just an annual check-in to see that they're competitive. They're doing it on a much more regular basis because they notice that it's a much more fluid environment. Some of the businesses that I've spoken to are also considering offering enhanced flexibility over and above the hybrid working solutions they've already put in place. And there are certain businesses who are already considering trialling the 4-day working week to see if that works with their business model. Interestingly, one conversation that does come up sometimes as well with the businesses is that They're looking to strengthen their environmental, social and governance propositions. I mean, there has been a heightened awareness over recent years in this area, and also on employee well-being. And I think a lot of businesses are starting to recognise that having strong policies in this area are making businesses more attractive to employees. And then finally, the final point that sort of I have seen with quite a few businesses, and I think is just a follow through from sort of what we were seeing last year, is there's increased outsourcing of certain functions, particularly clerical kind of roles. The survey results, particularly showing that this was a growing concern throughout 2021 and also into the first quarter of 2022, suggests this challenge, this isn't going to go away anytime soon. And it's going to be interesting to see how quickly businesses in the region can react through, say, the next quarter and quarter three, and also to see what other inventive solutions particularly come forward to deal with the issue. As has been highlighted by David as well, in addition to the workforce challenge, the cost of doing business continues to increase. Unsurprisingly, 3/4 of businesses surveyed in the Thames Valley region now state that inflation is more of a concern to their business than at the end of 2021. And just under 2/3 of businesses also reported that they expect to increase the price of their goods and services within the next quarter. And obviously, raw material costs and other overheads continue to be the main pressures. When you add this to the increase to the national minimum and living wages, the introduction of health and social care levy and the rise in interest rates, some of you might be forgiven for thinking that a perfect storm was forming for a lot of businesses. And from my perspective, in some sectors, this could potentially be very true. The care industry, for example, that I've had particular experience in over the last couple of years, faced significant challenges during the pandemic as a direct result of seeing sort of turnover reduced and staffing issues. They are now facing again further issues in respect of ongoing staff shortages, increased utility bills for running the care homes that they operate, and then also overhead costs, primarily insurance premiums, which have significantly increased. I was reading an article recently by the Institute for Chartered Accountants of England and Wales that was really put out to highlight the benefits of businesses forecasting and cash flow, creating cash flow models that they maintain going forward to keep an eye on how things are working. I think that's still key, but I think Russia's invasion of Ukraine has maybe also emphasised how important contingency planning is, not in terms of just identifying risk areas and possible solutions, but also in making sure that your business has the appropriate management and processes in place so that if a risk does occur, you can implement that solution quickly and swiftly to allow your business to adapt. In summary, I think with the ongoing uncertainty in the economy, expectation might be that business sentiment going forward, say into the next quarter, would be at the lower end of the scale. There are still positive results for quarter one with the sales increases, and 78% of businesses believing that turnover will continue to improve, and more than half of businesses believe there'll be a corresponding improvement in profitability. The caveat to that, however, is that the challenges identified at the beginning of the year and which businesses were planning for have now been further compounded by the ongoing uncertainty with regards to Russia's invasion in Ukraine. The stability, therefore, that I think some of us were hoping would start being seen at the beginning of 2022 hasn't yet materialised and may still be some way off. And that concludes my very quick run through of what I saw in the Q1 results and what I'm seeing from businesses. Tim, I'll hand back to you.
Thank you very much. Interesting, Christine, you talked about contingencies there that you've seen come in. Are you able to articulate any particular ones that could be? I realise we've got a broad brush of people on the call this morning, but have you seen any particular ones that have caught your attention? You thought, good thought. You're on mute, Christine, by the way.
Apologies.
You're all right, you're back in.
First technical area of the day.
You're in the room.
Yeah, I think some of the contingencies, I mean, obviously nobody would ever put a contingency in to say, okay, let's contingency for a war in Ukraine. No. But I think a lot of people have started to do stress testing on their cash flows. So looking at, okay, if we were suddenly we've got 3 major clients, if we were suddenly to lose one of those, how is that going to impact our cash flow? So really stress testing that position. and also stress testing what would happen if they lost one of their key suppliers. So I think that's the kind of contingency planning a lot of people are starting to put into their cash flow forecasts, just to see, okay, we know there's uncertainty out there now, it's been going on for a long time. If we lose key customers or key suppliers, how does that filter in, and when do we get to our crux point, and what can we do to maybe make sure it doesn't impact as heavily as it is at the minute?
Perfect. Thank you, Christine. Very useful. That was that's what it was about, useful and practical. Thank you so much. And just after we had the the survey, we also moved to the Chancellor's spring statement. So whilst it didn't deliberately impact on the numbers that David has talked about, clearly going forward, that's going to be an impact, positively and negatively, I suspect. But let me hand you to Ros Payne from BDO, who can perhaps sort of encapsulate that a little bit around our survey and the Chancellor's spring statement.
Thanks very much, Tim, and good morning, everyone. Thank you for inviting me. So I'm going to talk through what's going on in the tax world. And as already mentioned, we had the spring statement towards the end of last month, but actually the few announcements there were really dealing with the consequences of changes that had been announced previously. But arguably, what was more interesting was the pointers to future reforms in the so-called tax plan that Mr. Sunak had with him. And I will talk specifically about R&D and capital expenditure, because both of those are areas where we are expecting to see more changes this year. But before delving in, just a quick word on the context of the policy setting, and we've got a few factors at play here. So when we look at the vision which framed the spring statement, it's all about two things. So firstly, dealing with the immediate impact of the rising cost of living and the support that's needed now. But from a longer term perspective, there is an overarching ambition to reduce taxes as a whole. We do need to remain competitive internationally, and the tax system is a great way of incentivizing growth behavior. And this is a challenge. Tax revenues are really having to play their part in getting public finances back on track after all of the special measures of the pandemic, which we have alluded to. And actually, according to the OBR, the ratio of tax receipts to GDP is soon reaching its highest level since the 1940s. And of course, the increasing headline rate, the introduction of the health and social care levy and the allowances freeze are all a function of that. So we've got a tension between a low tax economy and getting us back on track. And interestingly, all of the measures that were announced in the spring statement, and that's the tax measures, are actually giveaways with a cost just shy of 50 billion to the Treasury over the next 5 years. But sitting alongside that is an ambition to raise funds through what is softly or maybe euphemistically called investing in compliance. And this is basically tackling tax avoidance and making sure that businesses are paying the tax they owe. It's not a new theme, but certainly some of the costs to the government of supporting people with living costs are intended to be delivered by protecting the tax base as well as increasing tax take from elsewhere. So with that context, what was announced? Well, I'll start with income tax. We weren't expecting much, but consistent with the theme of supporting the cost of living, there were a couple of announcements. So firstly, the thresholds at which workers start to pay national insurance are being increased from July. And this is really a way of softening the impact of the health and social care levy. It's coming in next year with an increase in national insurance rates in the meantime. And the changes will help all earners, but actually as soon as you earn, excuse me, more than £35,000 per annum, you will still be paying more tax as a result of the levy, albeit the thresholds changes will reduce the impact of that. And then the other announcement was the planned decrease in basic rate income tax of 1p in the pound. That's from April 24, and the Chancellor was very clear that that's assuming public finances permit. And while we're on people, we all know, certainly this was borne out in the survey, that businesses are feeling the pressure to recruit and retain talent, especially given high employment costs. And actually a key pillar of the government's tax plan has been termed sharing the proceeds of growth with the working people. We are being promised further reform of tax relief geared towards this. And we know they're looking at how the apprenticeship levy works. It has come under criticism in the past. And they're also looking at broadening the scope of share option incentives. Currently, they're looking at the company share ownership plan, and all of that is intended to help businesses support with attracting talent and retaining it. But certainly, as we get closer to an election, the challenges we all face aren't going to go away. So it'll be very interesting to see how the intentions they've shared with us will be borne out in policy going forward. So moving on to businesses, obviously it's well trailed last year, but generally companies will be paying tax at 25% from next April. It's a big hike and clearly reverses the downward trend of the last 11 or 12 years. And I think it's worth adding that whilst the headline rate is a measure of competitiveness, it isn't the whole story. And actually some of the incentives that the government gives us for certain activities are still there, and they're now more valuable pound for pound than they were with a 19% tax rate. And in particular, I want to talk about R&D and Capex. So starting with R&D, we know it's a generous relief, in particular for SMEs. It's always been a key lever in encouraging UK businesses to innovate. And everything I'm going to say is part of an ongoing consultation. But the announcements last month were twofold. So firstly, which expenses qualify for the relief? Cloud and data costs were always going to be added, but the government has clarified that data storage costs can also be included. So that will be a big benefit to software companies in particular. And in addition, they've also added a new category of costs which will qualify, and that's pure mathematics. So if you're in, say, the quantum computing or robotics technologies, that should broaden the scope of your claims. And it's all a sign of the intention to modernise. And then the other area where we got more information last month was around the location of R&D activities. The government wants to incentivise R&D, but it also wants to create UK jobs out of that. And it had announced that it was refocusing its incentives on UK activities. So in very broad terms, businesses that were outsourcing, even if it was in their group, were looking at no longer getting R&D relief for that. Whereas it has been softened now. So where there are material factors for why you need to outsource, you should now be okay to claim the relief. And the examples given are things like clinical trials with very clear regulatory requirements to undertake those elsewhere, or something like deep sea research. So the announcements in the statement were light, but we are expecting more in the summer. And just to put R&D relief into perspective, it is the biggest relief in the corporation tax regime. I think in 21 it was estimated to be worth over 9 billion. But if we add to that actual spending on R&D in the UK is estimated to be 4 times the value of claims made, whereas the OECD average is 15 times, it does indicate that the relief may be a bit more generous than the amount of spending it's currently encouraging. So we know the government will be looking at this. We know we're going to see more on tackling abuse, and extra resources to do that were announced in November. We know the government's looking at the generosity of the RDEC scheme, so that's the currently less generous scheme available to large companies. So we could see more evening out between claims made by large companies and SMEs. It's possible they will differentiate by sector or even by geography to support the levelling up agenda, and use that as an incentive for certain activities. And it may also be that the mechanism for relief changes. So, for example, we might be moving to a more incremental type of relief system used in some other countries, for example, the US. So there's quite a lot we could do. Certainly we and a number of firms are active in the consultation, so it's really watch this space. So I want to move on to Capex now, and although there were no new announcements in the statement, Capex is interesting because one criticism in the past has been that although we've had and arguably still have a competitive tax rate, it is undermined by a less competitive and fluctuating relief for capital expenditure. So the super deduction was announced from last April, which was a boost to businesses, albeit it was necessary really to prevent everyone deferring Capex to after the tax rate increases next year. And similarly, we've got a raised annual investment allowance, which basically allows businesses to write off the first 1 million of investment in Capex made in the year. This is due to go back down to 200,000 next April. So with both of these incentives, we're less than 12 months away from a reversal. So the government's consulting on reforms. It clearly does still see capital allowances regime as an incentive for growth. And they've actually set out a few options in the tax plan for what this might look like, ranging from setting a permanent annual investment allowance at £500,000 all the way through to writing off 100% of expenditure in the year you buy the assets, which is obviously fairly extreme, but is part of the law in a number of countries. We'll probably end up somewhere on the scale, but we will have an opportunity to feed in thoughts on this before announcements likely in the autumn budget. And then finally, before I hand back to Tim, I did just want to talk a bit about environment. Obviously, the reduction in fuel duty by 5p a litre for just over 12 months was already known before the statement, but interestingly, the predictions for fuel duty receipts do seem to assume an increased mileage going forward. So it's quite an interesting message embedded in the short-term desire to ease the cost of living, given that the overall desire is to reduce traffic on the roads. But there were some encouraging environmental announcements. So, for example, the VAT on energy saving materials, so things like solar panels, will go from 5% to 0% until March 27. And the Chancellor's also brought forward a business rate relief if you buy plant and machinery used in on-site renewable energy generation. It won't add to the value of your property when you're calculating your rates. That was due to happen next April. That's now in place from this April. So that's really all I had to say on the spring statement. As I say, there weren't many new announcements, but quite a lot of themes which were filtering through it from previous announcements. And I think what will be really interesting is the activity and the consultations in the run-up to the autumn budget, in particular when we put that in the context of a future election. Back over to you, Tim.
Ros, thank you ever so much indeed, very kind. Last but by no means least, Janet Moy, Brewin Dolphin. Your comments, please.
Hi, good morning, everyone. Thanks for having me as your speaker. And what I want to say is our thoughts echo a lot of what David and Christine has already mentioned, which is that inflation is definitely front and center, especially for investors. And we are actually seeing more headwinds to growth going forward. And my slot today is more analyzing it from a global perspective. So in terms of global growth, we see that there will be a continuous slowdown. That is already being expected at the start of the year, given that we had such a strong year last year. But I think now we are seeing more and more economists from Wall Street or the governments or the central banks, they are revising down growth forecast, and that's across the board. And I can't rule out any more downward revisions because I think the headwinds are certainly building. And so we at Brewin Dolphin, we are turning more cautious on our macroeconomic view. And the key reason is definitely inflation. I think what I want to highlight is that I think this time around, we are seeing more evidence that inflation is becoming more entrenched. And this inflation is a bit different from what we experienced during the pandemic. Of course, inflation has been very high throughout 2021, but because of the war in Ukraine, I think it had changed a bit of the nature of that. During the pandemic, what we saw was that inflation was actually, it was rising, and initially, it was driven, of course, a lot by energy prices and also the reopening categories when we eventually reopened and we had the vaccine. So what you saw in the categories is more discretionary items that are seeing significant price rises. For example, you're talking about airfares, you're talking about the cars, trucks, secondhand cars, etc. But what we are seeing now is increasingly more the essentials that are seeing really great price increases, which to us is a real concern, because we're talking about the food prices, which are seeing quite strong continuing increases, especially that would be driven more by Ukraine going forward. I don't think we have actually seen that in the data yet. And also the rental prices have been picking up very sharply. That is a lagging that house price increase we have seen over the past year or so. And of course, the services sector prices as well has been going up. And all these suggest to us that inflation is likely to become more entrenched and more structural in nature. And so that's why it leads to a more cautious macro view, because I think what we're seeing now is a significant squeeze in household real income. We saw today, from the UK jobs report, the wages are growing pretty strongly at about 4% on regular wages. But if you strip out inflation, it's negative, and it has been negative for a couple of months already, and it's likely to last throughout this year. And similarly for the US and many major Western economies as well, we are seeing negative wage growth everywhere, basically. And eventually that would be quite detrimental to consumer spending. And for the US, which is basically, for investors, for financial institutions, we all pay a lot of attention to the US, given it's the largest economy. And there, the labor market is very, very tight as well. Unemployment rate is back to where it was pre-COVID, and negative real wage growth as well. And what we saw is that consumer confidence is actually very bad. It has slumped quite significantly over the past year or so. And I think that has a lot to do with the energy prices. So overall speaking, we think that the economic headwinds are building, growth is going to slow, and there are increasing talk of a risk of a recession. So we monitor a lot of indicators, and some of that suggests to us that there will eventually be one, but the timing is very, very hard to gauge. I mean, it could be any time from a year to 2 years ahead. So the timing is very, very difficult to gauge. But if you hear the Federal Reserve officials, they're saying that it is, of course they want to avoid a recession, but it may be potentially very hard to do so. And about interest rates, well, it is pretty clear that we are going to see a range of interest rate increases throughout the developed economies. And in particular, US, actually, there has been such a dramatic shift in interest rate expectation. So now financial markets are expecting 9 quarter point rate increases in the US. So that would bring us to a 2.5% of Fed funds rate by the end of this year. It is unclear whether we will get there, but it seems that it is likely given what the Federal Reserves are saying to us these days. So we're looking at a significant tightening in financial conditions. And the UK interest rate outlook is similar, but a bit less high. So financial market expect UK bank rate to end at about 2% by the end of this year. The Euro area, I think the financial market expect just about two rate hikes, potentially bringing back to positive, but we don't know. But it's definitely the most dovish central bank out there. But anyway, I think the key economies are definitely facing a series of rate increases. And a lot of those rate increases will be basically, it's going to happen within the next 12 months. So with that environment, you're talking about high interest costs to companies, high interest refinancing costs for households if they need to refinance their mortgage. You're talking about negative real wage growth. So we're talking about quite some reversal in the very accommodative conditions we were talking about a year ago or so. So that's why we are turning more cautious. And it is still very hard to gauge whether we will see a recession in the near term or so. Probably not. Probably is a case of 2023 in our opinion, because right now the labor market is strong. So people still doing well in their savings and pent up demand. So we don't expect it to be happening this year. But I think there will be definitely more talks about it next year. And of course, a lot of that is not being shown in the data yet. I mean, rate increases are just starting to happen, for example. And as I mentioned, the squeeze on the food prices and the struggles, it probably wouldn't be more evident until later part of the year. So ultimately, we're having a more cautious view on the economic outlook. And even if we don't see a recession, we'll see a slowdown anyway. And I suspect the growth outlook will continue to be revised down by the international financial community. So that's the global view. And I'm sure there will be more questions for us later on.
Yeah, Janet, I had one question. I was interested to hear your view on interest rates. And I was wondering, is it possible to understand, maybe Christine wants to come in on this one as well, the shorter term pressures, such as oil, how much more than structural factors have on that sort of rate of inflation that we're seeing? Because I suppose not just from an investment perspective, but also for businesses managing costs. I wonder what you think that sort of perspective is.
Yeah, so what we think is that the near-term outlook for oil prices will still be quite strong, and so oil prices will remain quite elevated. I think recently oil prices have retreated because of the lockdowns in China, which people are concerned about a slowdown in demand. But actually, ultimately, the supply of oil remains very tight. And what we saw is that there's a general reluctance from the OPEC members to release more oil into the market. It is pretty clear from that. So what has been helping has been the strategic oil reserve release from the US. But I think that's ultimately structurally is not going to be very helpful in the long term, because if you're talking about Russia it actually produces about 10 million barrels of oil per day. And it is, OPEC members already say they cannot replace those amount lost. So if you're talking about structurally, the West refusing or self-sanctioning against Russian oil, you're talking about quite a significant loss in the barrels per day. And if your demand is still picking up in terms of aviation, we saw the news that EasyJet is saying the summer holiday demand is back to where it was in 2019. So there's still quite a good demand for fuel. And so you're talking about quite a tight supply demand dynamics there. And structurally speaking, even though oil price is high, there continue to be a genuine reluctance to invest because of ESG considerations, right? Environmental reasons. So historically, the US, the shale oil producers would be drilling ferociously if oil prices are this high, but we didn't see any significant pickup in the activity. So it does suggest to us that structurally speaking, supply will remain depressed because of the lack of investments, even at these kind of oil prices.
Thanks, Janet. And Christine, moving back to skills, if I may, Christine. We've seen record vacancies. Do you think that hiring crunch as we've got now we'll see that sort of further slow down in the economy, or do you think actually we'll just learn to live with it?
I think it will impact slowdown, particularly in next quarter, in terms of some of the things that a lot of businesses are looking now to do is invest in training. So instead of trying to bring up other members of staff to fill roles and gaps, but the problem is the knock-on effect that takes time to implement and actually put in place and have a reaction for the business. So yeah, I think we are going to see it still be a problem, sort of, particularly. I'll be interested to see what the figures show for next quarter, definitely.
And do you think the Bank of England will have to throw away its target about inflation at 2%, or do you think it'll have to inflate base lending rates?
I would not like to predict anything.
You know
on that
what question
respect,
is coming next. Yes. So we've got inflation currently at 6.2, chaps. So where do we think it's going? David, I've mentioned to you that I think that it's that there is a pent-up inflation? Where do you think we might see it at the end of the year?
It's difficult to say. I mean, forecasts are looking at somewhere between 7 and 10%. I think the ABR were forecasting 7.2% by the end of this year. So, yeah, I mean, the direction of travel seems to be in one way at the moment. I'm not sure that the Bank of England are going to be able to rein things back in to their 2% target. Obviously, interest rates are likely to go up as well. But the challenge we've got, obviously, is that the inflationary pressures are coming from such a wide variety of sources that there's no single monetary policy instrument that can be applied here. If there's a global supply chain shutdown, it's not really in the Bank of England's gift to do much about that.
I'm mindful that we are coming to the end of our time. If no one's got any further questions, we'll look to just a quick sum up, if I may, because it's important to get everyone away for the next meetings. I think the business sentiment we've seen remains high. We've seen the challenge of inflation, supply chain, and people issues. We have great businesses across our region, and and I think never more so has that been highlighted in our business awards, which are coming out and available to everybody right now. I think we've all been, within the chamber, we've been absolutely delighted by the response we've had from our businesses and our supporters, I may add. We have everyone from James Kappa Creston who've supported us, and to Heathrow. So we've got this huge eclectic mix of businesses. So do take the opportunity to enter yourselves. It's not about winning, it's about partaking, because how great is it to actually just join in and see where you end up. And that all ends up on our awards night on the 23rd of June. Quarterly Economic Survey is here with us for the rest of the year. What I ask of you every quarter, everybody, is to join in that survey. Your response really is really very welcome. If next quarter, from middle of next May, then if you would like to come and talk to me on a one-to-one basis, I'll be happily delighted. I have to say it's really fulfilling to do the survey with you. Though surveys themselves are never the most exciting things, the outputs, as we've seen, when you join everything together through David in his offices at the British Chamber of Commerce, proves how invaluable that output. Because what you need to do next is go back into your own businesses and decide how much of that you need to think about within your own business. It just remains for me to thank David from the British Chamber, Christine and Ros from BDO, and to Janet from Brewin Dolphin. Thank you for your support. I think we could have carried on, to be honest with you, but we better not, because it's good to finish bang on time to head off to our next jobs. It just remains for me to say thanks ever so much for joining. Really appreciate it. And we will do this all again on the 12th of July. I will see everybody then. Thank you for your time. Thanks for your input. Really appreciate it.